There are fears of an extreme AI bubble currently in the stock market, and it has the ability to bring down the US economy. However, I don't think that is the major issue facing us right now. Yes, there are some companies out there that might have extreme valuations. OpenAI, for example, I believe it's recently got a $500 billion valuation, and I don't even think it's profitable yet. Those are some extreme cases, but they're not enough to bring down the entire economy or stock market. If we look at some of the big tech companies out there, the biggest in the stock market, for example, Nvidia, they are sitting at a forward P ratio somewhere around a 28, and they're expected to grow profits year over year at around 30% moving forward. You can make an argument right now that Nvidia is actually quite cheap. As soon as your forward P ratio is lower than your percent profit growth year over year, then you're sitting in a really good place. I guess the key is that assumption that the growth is going to be maintained in the future, but more on that later in the video. And moving on to the more commonly known software names such as Facebook, Meta, they own Instagram, WhatsApp, and Facebook with around 4 billion users worldwide. Facebook is still growing profits moving forward around 25% year over year with a huge underestimation from analysts. That's actually my favorite company right now for that very reason. But the forward P ratio on Meta is sitting somewhere around a 20, again, with a P ratio lower than future growth. So again, there are many companies out here, big tech names, even middle tier companies with still attractive valuations. As long as you stick away from companies like Tesla, in my opinion, which are extremely overvalued, we should be okay individually stock picking. That leads us to the main story in this video. Really, the valuation story, I think, is some cover to the real problem that's growing in the economy right now, which is the reliance on really two major things we've been talking about on the channel for a while. The first was big government deficit spending, which basically ripped us out of a recession in 2022, and the other was the huge amount of capex or capital expenditures that were happening from big tech companies. Worldwide artificial intelligence capex is expected to hit around $2 trillion in the coming year. That has created a lot of excitement about economic growth maybe re-accelerating over the next couple years. A lot of excitement that has really driven the stock market to all-time highs in the last really 3-4 months. However, whenever we have these huge promises of massive profits and revenue stemming from this investment, maybe we expect around a 20% return on that investment every single year. That's $400 billion worldwide that we need to generate out of thin air in the next year to make investors happy. At this point in the video, I try to go through and find a bunch of evidence to support the pro and the con argument there about AI generating enough business worldwide, but I came across pretty quickly the CNBC interview between Andrew Ross Sorkin, the host, who is anti-AI in this argument, and the CEO of an investment firm, Activate, Michael Wolff, and they're putting these two arguments together about whether this AI investment has been worth it and if we're going to disappoint Wall Street. To begin the interview, they really do hash out in just layman's terms this idea of circular investing.
AI giants NVIDIA, OpenAI, and Oracle have built a circular network of billion-dollar partnerships, each relying on the other as the AI wars accelerate.
You have no concern at all about how you're taking companies that effectively can't afford to make the commitments that they're making, right? They can't afford to make the commitments they're making, just empirically. They don't have the cash.
Right.
And so they are getting the money from, in the case of NVIDIA, they're getting the money from the folks who they're making the commitment to buy the chips from and using that money to go buy the chips. Meantime, you can look at the AMD deal, which is the reverse of that, which is, okay, we can't afford to buy the chips, but we know that if we commit to you, your stock is going to go up. We'll take warrants in your stock. Your stock is going to go up as a result of this. We're going to be able to take the money from that and go buy the chips that we also couldn't afford to buy.
At this point, we're going to see both people lay out their arguments here, and you see the host really lay it on thick. But either way, let's see these arguments play out.
You could have a shift in the sentiment in the marketplace. Right now, for whatever reason, the stock market is giving folks higher valuations when they say they're going to spend more. That's unusual.
But they're investing really because there's going to be real demand.
Even close to profitable? No. So yes, there's demand at not, by the way, there was demand for MoviePass too. but the economics of it didn't work.
So, well, the economics didn't work, but not at this scale. ChatGPT, 5 to 6 billion visits each month, and the revenue is there. I mean, it's growing fast. But but that compares to Google today, which is close to 200 billion visits a month. And so much of what Google is going to deliver is when you go to a query, it's going to deliver an answer with Gemini. So when people
but the marginal cost of delivering that answer is so much higher than what it was.
Absolutely.
Okay, so that's a real issue.
Just breaking it down, we have this idea of the amount of demand for AI products just skyrocketing. Yeah, that's probably true. Usage of AI and ChatGPT is probably going up 50% year over year, something like that. But how many people are paying more and more for the premium services over time? Yeah, we've already had a bunch of people sign up for whatever it is, $40 a month premium. But are we going to see more and more the people using that double every year for the next 5 years? I'm suggesting here that the amount of people buying the premium service is eventually going to plateau, and probably very quickly. Everyone that's going to pay for premium AI has probably done so already in the last year. Just using myself as an example, I use AI pretty much every day, both with my main job and also here on the channel. And I've never paid for it. I just use the free trials, or I just use the Gemini or the ChatGPT versions for free. I'm just not going to pay $100 a month for that service when there's other companies always trying to gain market share and not really charging you a cent. So in terms of companies needing to generate $400 billion in the next year in extra revenue, I just don't see that happening. At some point, we are going to see a slowdown in this investing trajectory. So in that sense, I stand with the host that, yeah, demand is there, but that's not the answer to everything, and that doesn't necessarily convert to pure profit. And when we throw in the idea earlier about circular investing, if we have some of those companies one after another start to drop down their investment, that lowers the valuation. And because other companies have bought shares in other AI chip companies or AI software, and therefore, if we see AI investment go down, we see profits of these companies also start to collapse, and you get this really nasty domino effect. That last happened in 2022, and we didn't even go through a really harsh recession. There was some fears about inflation and interest rates, but the unemployment rate did not skyrocket, and we already had names like Meta that were down like 76% in a year. Nvidia was down 66% that year. To finish off the video here, I do have one more clip from that interview, which just goes into the argument of, yeah, even if we do have the positive case come true and AI demand is healthy and it generates enough profit, even in that scenario, we could have a negative outcome for the economy. So rather than trying to look for a win-win where no matter what we make our money with investing, if anything, we're starting to look at a lose-lose. If AI fails, then yeah, we get put in a recession, especially for America, where a lot of these AI companies are centered. But even if the AI companies do well, then that's going to lead to more unemployment. Again, that starts recession, and it's just a negative feedback cycle.
Sustain these kind of valuations and to have the kind of investor support we're talking about, they're going to have to create a lot more productivity in our economy. Now, productivity is also a euphemism, typically, for less jobs. And so if you have either mass unemployment or just a lot of unemployment, how do you think that in of itself impacts the rest of the economy and maybe even these companies themselves?
We are getting really close here to just being true doomers and gloomers, but I do like to pose solutions to these problems on the channel. That's what I think makes a difference between us just being fear porn and actually trying to educate and just share my experience that I've learned investing in the last decade. But overall, I just see that we always need to look towards the future, and we just need to pick single companies that are going to reward us given this scope that we're starting to see out in the environment. So I do see that some big tech companies like Meta have a decent valuation still, and even if we see the AI investments slow down, the profits of that company coming from Instagram, Facebook, and now WhatsApp for the first time getting monetized, that should be enough to carry Meta through over the next couple years. And eventually we need to start transitioning, I think, our portfolios to more defensive dividend companies, maybe by the end of 2026 fully perhaps. But at the moment, I'm starting to do that by buying up K-View, which is actually an old branch of Johnson & Johnson. If you enjoyed this video, I've got 2 more for you to watch, all about learning about the economy and how that could impact our investing and the stock market.